In this lecture, we will discuss optimal risky portfolios and security selection. Portfolio evaluation is analyzing securities in terms of their characteristics, such as value, return, risk, marketability, and so on. When we evaluate portfolios, however, we tend to focus on two characteristics: portfolio return and portfolio risk. Nobel Prize-winning economist Harry Markowitz, in his 1952 seminal article, he stated that the objective of portfolio selection is to determine the allocations of securities in a portfolio that's going to give us the maximum expected return for a given level or specified level of risk. Or we can kind of flip that upside down and select a portfolio that has the minimum level of risk for a given portfolio expected returns. Portfolios that meet those criteria are called efficient portfolios because they yield the best risk-return trade-off. In this lecture, we're going to examine three key parts of Markowitz's portfolio selection process. We're going to discuss the importance of correlation in determining the different risk-return combinations in the context of a two-stock portfolio. And then the second thing we're going to examine is how to take this information from the different risk-return combinations for that two-stock portfolio, and how do we select the portfolio? What combinations of the two stocks will give us the most efficient portfolio? And then we're going to extend that concept to larger portfolios, to single index and multiple index models. So let's go back and revisit diversification. As we've discussed before in this class, when we think about portfolio risk, we can measure that risk with standard deviation, which is the variability of the returns of that portfolio. However, as we add more and more securities to that portfolio, we see that the total risk, the variability of those returns, tends to fall. And that's because we're diversifying away this unique company or stock specific risk. But no matter how much we add more and more stocks to our portfolio, there's a certain amount of risk that we can't get rid of. That's that market, or we also call that non-diversifiable risk. And certainly today, as I'm making this video, we're watching the financial markets. We have this coronavirus scare. That is a non-diversifiable risk. It's a market risk that we cannot diversify away from. All stocks have been impacted by this event. More to the point right now, what we want to talk about, in the context of portfolio selection, we would much rather get down to this level of diversification where we only had market level of risk. We'd much rather accomplish that with, say, 5 stocks than with 500 stocks. Because with 500 stocks, we're going to have a lot of trading costs, a lot of research, a lot of resources we have to spend to maintain a portfolio of 500 stocks, as opposed to a portfolio of only 5 stocks. So we want to find combinations of stocks that we can put in a portfolio that gives us the most diversification with the fewest number of stocks. So let's begin by reviewing this two security portfolio. All right, so in two security portfolio, we talked about risk, and we've covered this before. We look at the variance of portfolio, and that's the weight in the first asset multiplied by the variance of that first asset, the weight of the second asset multiplied by the variance of the second asset. And then we got this, how the two assets move together, their covariance. And once we know covariance, we can calculate something called correlation coefficients. And those correlation coefficients, I know this is all review, these correlation coefficients, they have a range from a +1 to a -1, so something that has a +1 correlation coefficients, those two securities would be moved together perfectly. We say that they're perfectly positively correlated. And at the other extreme, when the correlation coefficient is -1, those securities would be perfectly negatively correlated. They would tend to move in different directions. And we've seen this all before. So with a two security portfolio with different correlations, we covered this in the previous lectures. And with two stocks that are perfectly positively correlated, we see this linear relationship. So as we take on more and more risk, we get more and more return. return. And then we have this less than perfectly positively correlated two stocks, and we can see this kind of a little bowing here as we vary our proportion from one asset to the other asset. And then we have the case here where we have perfect negative correlation. So let's dive into this concept of correlation for our two security portfolio in a little bit more depth. Consider a portfolio that's formed from two perfectly positively correlated stocks A and B, and we see the following expected returns and variances for stock A and B. So we can create different combinations of these stocks to form different portfolios, and we can see how these different combinations affect the portfolio's risk and return. So again, we're talking about two stocks that are perfectly positively correlated. So from these two stocks we can form 5 portfolios. We could do 10, but in this example we'll just do 5. And this first portfolio we have 100% is invested in stock A, so we have a weight of 1, and 0% is invested in stock B, such that the expected return on the portfolio then would be the same as the expected return on stock A, and the standard deviation of the portfolio would be the same as the standard deviation of stock A. And then at the other extreme, portfolio number 5, we have 0% invested in A, 100% invested in B, and again the expected return and standard deviation of this portfolio are the same as the expected return and standard deviation of stock B. And then in between here in 2, 4, and 5 we've got, for example, 75% in A, portfolio 3 has 50% in A, and portfolio 4 has 25% in A, and again the weights have to equal 1 or 100%, and we could calculate the expected returns, and we could calculate the standard deviation of the portfolio using the two-stock variance formula we discussed earlier. So we can fill in all these values here. And when we plot these portfolios, we see a linear relationship between risk and return. Now intuitively, if two securities move in perfect unison, that is, they have a perfect positive correlation, there's no correlation benefit. And the different portfolio return and risk combination are simply linear combinations of the two securities returns and risk. And mathematically we can see that when we look at the variance of the portfolio, looking at our variance portfolio formula, and then we kind of move that into covariance, break that down into the correlation coefficient multiplied by the standard deviation of stock A and the standard deviation of stock B. We plug in our value of 1 for the correlation coefficient and do a little bit of algebra, factor that back to its components here. For the variance, we take the standard deviation of that, and we can see for perfectly positively correlated portfolios, the standard deviation is simply the weighted average of the standard deviations of the two stocks in the portfolio. There is no correlation benefit. Now let's look at the other extreme when we had stocks A and B are perfectly negatively correlated. So we're going to do the same thing here. We're going to create portfolios going from a weight of 100% in A down to 0% in A, and 0 in B up to 100% in B, and then we have the interim. And using this information here that we're given, the only thing that really changes here is our correlation coefficient is a -1. We can calculate the expected returns and the standard deviation of that portfolio, again using our two portfolio standard deviation formula. And we can plot the returns of each one of these portfolios. And there was one here I didn't get plotted, and that is when we are 100% in A, right? Because in 100% in A, the standard deviation would be 4, and the expected return would be 12. It would be right here, and that would just be a straight line extending to right here. So my bad on that. Now when we look at this, we see this kinked relation as we saw before. So for example, right here, this is portfolio 2, where we're 80% in A, 20% in B. We have a standard deviation of 2, and then expected return of 13.2%. So this is portfolio 2. And then if we move up to portfolio 3, where we are 60% in A and 40% in B, we see here we have an expected return of 14.4% and a standard deviation equal to 0. And then as we move up here, this is portfolio 4, 40% in A, 60% in B, and here we see a standard deviation of 2 and an expected return of 15.6%, and then we continue on with portfolio 5 and portfolio 6. Now notice here portfolio 4 compared to portfolio 2. They both have the same level of risk, but portfolio 4 has a higher expected return. So which is the one that we would pick? Obviously we'd pick portfolio 4 because it gives us a better return risk trade-off. We would say that portfolio 4 is efficient, whereas portfolio 2 is inefficient. So this segment here, any combinations on this negative slope line, those are inefficient portfolios. And our combinations here on the upward sloping line, these are efficient portfolios. The third case we want to discuss is the zero correlation situation where stock A and B have zero correlation with each other. So we'll repeat this process for our portfolios, calculating with different weights on A and B, calculating the expected return and the standard deviation. And now we see this relationship here. It's not a straight line because the correlation coefficient, remember in the formula, let's go back to that formula real quickly. Our formula here, right, we have the two weights and then the covariance, and we can break that down to the correlation. We can see here we no longer have a linear relationship. So we start to see this curve here. And what do we see here? We see the same thing as we saw with negative correlation, in that there is an efficient portion and an inefficient portion. And then we also see that as we get more and more into just this one stock right here and more into stock B, the portfolio starts to behave pretty much like stock B. So for example, when we get to this point right here for portfolio 5, which is 80% of B and just 20% of A, its expected return and risk are pretty close to what stock B is. We call this convexity, where the level of return you receive for each unit of risk is decreasing for each increase in risk that we have. We call that convexity. In other words, as we get into these combinations that are up here in this convexity range, we're less diversified. So we have less of that correlation benefit, less of that diversification benefit in these combinations. Looking at another example of different correlations here, this linear line right here, again, that's the perfect positive correlation. We have a +1 correlation coefficient. The kinked line over here, this is perfect negative correlation. Here we've got a correlation of 0 between the two stocks, and here we have a correlation of 0.5 between the two stocks. But notice that the further we get away from perfect positive correlation, so let's just take a midpoint right here for this level of risk. Let's just, where I've got the arrow here, let's just look at this level right here. If we go to a correlation coefficient of 0.5 for the same level of risk, we're getting a higher return. And if we even go further away from a correlation of 1 down to a correlation of 0, we even get a higher return for a given level of risk. And if we get as far away from a perfect positive correlation we can, in other words a perfect negative correlation, we get an even higher return. So this provides us some insight into diversification. The less correlated our stocks are going to be, the larger the correlation benefit is going to be, the larger that diversification effect is going to be, and the fewer stocks that we will need to form an efficient, diversified portfolio. Now for each of these lines that we see here, where the correlation is 0.5, the correlation is 0, we have this point right here where we've minimized the risk, and we call that the minimum variance portfolio. In other words, with our two stocks, we cannot get less variance than that. That is the least risky combination of stocks that we have. And we can find that point by using a bit of calculus, taking our, again this is for the two stock portfolio, taking our, let me just go back here real quick, taking our variance formula, taking the first derivative with respect to W1, setting that equal to 0, so a little bit of our calculus, and solve for the value of the weight on stock 1 or on stock A. If we do that and then do a little bit of algebraic manipulation, we can find this, the weight of stock A, and of course the weight on stock B would just be 1 minus the weight on stock A. We can find the weights for our portfolio that will give us this minimum variance portfolio. In a two-stock scenario, each one of those combinations is associated with one allocation. So we have 40% in stock A, 60% in stock B. That's one allocation. However, when we have portfolios with more than two securities, maybe 10 securities or 20 securities or 30 securities, whatever, we have a lot more of allocations, right? We have different possible combinations that we could have. We have a number of allocations that can yield the same portfolio return, and we may have a number of allocations that can yield the same portfolio risk. Whenever the number of securities in a portfolio exceeds 2, then the portfolio selection problem is determine the allocation that's going to yield an efficient portfolio. In other words, what is the combinations of different securities, what's their allocations that gives us a security that has the highest expected return for a given level of risk, or flip the other way around, for a given expected return gives us the minimum level of risk. What is these efficient portfolios? That is the Markowitz portfolio selection criteria. In the text, you will see a mathematical approach, a quadratic programming approach, a numerical approximation approaches. We're going to kind of skip over that for right now, and just kind of graphically looking at what this Markowitz portfolio selection criteria looks like. So when we have more than two securities, so we have lots of different securities, we can have different combinations of these securities. So this particular combination of securities may give us this standard deviation and then this risk, and this combination here would give us this standard deviation and risk. So we have lots of different combinations, different weights under each of the different securities, and there's going to be some combinations that are going to fall right here on this line right here, this curve, where it gives us the maximum return for a given level of risk. And those points for each of the different combinations, right, for each level of risk, we're going to find one combination that gives us the highest return. We call that the minimum variance frontier. And that portion that's upward sloping, this upper part of the minimum variance frontier, we call that the efficient frontier. These are the efficient portfolios. And then we can also identify the global minimum variance portfolio. And then down here, these portfolios, even though they're minimum variance, right, these are all inefficient because there's portfolios that for the same level of risk have higher returns. So these are inefficient. So even though they're on the minimum variance frontier, they're efficient. So this right here, this is what our selection process. We want to identify what are the stocks, combination of stocks, that will land us on this efficient frontier. Now, if we extend this concept to include a riskless asset, as we saw before with the borrowing lending line, the combination of risk and return becomes linear. So for each point on the efficient frontier, for each portfolios, for example, portfolio M or portfolio P or portfolio G, we can have a linear combination of that portfolio with the risk-free asset and have the lending section. So for each portfolio on the efficient frontier, and let's pick out three portfolios, portfolio M, portfolio P, and portfolio G, these are the different combinations. When we combine those portfolios with the risk-free asset, so let's look here at G, we have the lending section, and then we have the borrowing section. Here we're assuming the borrowing rate is equal to the lending rate, so we don't have that kink in the line. An investor can have higher levels of risk, but also be compensated with higher level of return for each one of the portfolio. So for portfolio M, we would have this linear combination, and portfolio P, we would have this linear combination. Now let's go back to, let's forget about the risk-free asset for just a second, and let's look at the efficient frontier. Like, who would be selecting each one of these different portfolios lying on the efficient frontier? If we go back to our economics courses and the concept of utility theory, where investors would like to have higher utility as opposed to less utility, in the context of risk and return, we may have an investor here that's very risk adverse. And by risk averse, we can see this here by the slope of this curve. As they take on more risk, they demand a lot more return. Whereas the less risk adverse investor, a little bit extra risk, he wants higher return, a little bit less risk, a little bit less, but it's much flatter than it is with the more risk adverse. But for both of them, as the risk gets really, really high, the required return, in other words, that's going to make them happy, gets higher and higher. And then we have here this point here, this investor here, and we can see his utility curves are right here. So to illustrate this for this particular investor right here, he's got a utility curve here. He would like to have higher utility. And can he get higher utility? Well, he could be at this point and get this return, or he could be at this portfolio and get this combination of risk and return. But if he can jump up to the higher level of utility, right, where it just meets this portfolio right here, this portfolio will give him the highest level of utility, and there's no combination, no other combination of securities would get him even higher. So this investor right here is going to choose to be at this point right here because this gives him the highest utility. The same with our more risk adverse and less risk adverse investors. We're just not showing those utility curves for them. So the optimal risky portfolio is going to be that portfolio of risky assets that has the best risk and return trade-off. That's our optimal efficient portfolio. In other words, it's the portfolio with the highest Sharpe ratio, and we discussed Sharpe ratio in the last chapter. The optimal risky portfolio, we can locate that graphically as the tangency point of the capital market line. In other words, when we're adding the risk-free asset and the efficient frontier. So here's our risk-free asset. Here's our tangency point with the efficient frontier, that is this portfolio P. Now, why is this important? Well, now that we have the risk-free rate we can borrow and lend at, our investor over here that may have been further down on the, say, the global minimum variance portfolio, maybe this investor was all the way down here in his utility curves. Well, with the presence of the risk-free rate, he can jump up, and for a given level of, let's say right here, a given level of risk, he can get a higher level of return. And over here too, for the less risk adverse investor, that perhaps they were laying right here on the efficient frontier and they had this utility curve right here, they can borrow at the risk-free rate. In other words, borrow to leverage their position in portfolio P and jump up to this higher level of utility, jump up to a higher utility curve. Investors will all find that this portfolio right here is the optimal portfolio regardless of their individual utility curves. In other words, regardless of their individual risk-return trade-off preferences. In the next lecture, we will extend this concept to the market portfolio.